Hi, I'm Rick Kaler. Thanks for joining me. Retirement investors flock back to stocks. That was the front page headline of the Wall Street Journal on May 2nd, 2014. I retweeted the article to my Twitter feed, adding, just in time to ride them to the bottom again. 5 years ago, some of those same investors were abandoning stocks in sheer panic. In early March 2009, the Dow Jones Industrial Average hit a low of around 6,700. Many financial advisors spent hours listening to frightened clients wanting to sell out of their entire portfolios and go to cash. It was an exhausting and traumatic period for advisors and clients. Those who followed advisors' recommendations to stay the course certainly came out on top. Their portfolios recovered nicely, with double-digit annualized returns for the past 5 years. Even over the past 10 years, most diversified portfolios earned very respectable returns, far in excess of bank CDs or bond yields. Unfortunately, those who panicked and sold out paid an incredibly high price for the momentary relief of getting off the market roller coaster. Many of them kept their money on the sidelines until recently, waiting until things were better to reinvest. Apparently, things are better. The time has come. Here are some numbers from the Wall Street Journal article. Retirement investors have recently increased their stock holdings by almost 40% from market lows. Today, bond and money market funds make up only 25% of retirement plans, and 67% of new 401k contributions go toward purchasing stocks. In 2007, bond and money market funds accounted for 21% of retirement plans. At the top of the market, in October 2007, the average new 401k contribution was going into stocks, almost 69%. Within 18 months, stocks had declined almost 60% from their highs. Now, do you see any potential correlations here? I have little doubt these individual investors are mistiming the market once again. They're setting themselves up to get slaughtered all over. But what about those who did get out of the markets 5 years ago and now realize they made a big mistake? Suppose you've learned the wisdom of staying in the market with a well-diversified portfolio. How do you get back in without waiting for the next crash? Well, here's 3 strategies to rebuild your portfolio. First, don't go all in, but move into the market gradually with dollar cost averaging. Over the next 2 years, methodically, that's either monthly or quarterly, buy into a diversified mixture of asset classes. If the market turns downward, which carries a high probability, you'll buy into a falling market. You will also reduce the possibility of a huge market drop that might cause you to panic and sell out again. Second, allocate your purchases to a mixture of U.S. and international stocks, as well as options such as real estate investment trusts, commodity funds, managed futures, treasury inflation protected securities, that's TIPS, high yield bond funds, and high quality bond funds. Finally, once your 2-year dollar cost averaging is done and you're fully invested into your asset classes, rebalance at least once a year. I like to do it at least quarterly myself, and that will maintain your original allocations as the value of those assets will change. For example, if you have allocated 30% of your portfolio to stocks, purchase more stocks if stocks add up to less than 30%, or sell some if they're over 30%. The research suggests that there's a high probability that things will end badly for individual investors who try to time the markets. A few will succeed, but will confuse their skill with the fact that they just got lucky. A methodical approach provides a strategy to help you hold on, even in the face of market ups and downs. Thanks for joining.